Hi, welcome to the FinTech Times Presents series of webinars. Established in 2016, the FinTech Times is a global multimedia news outlet centered around the world's first leading FinTech newspaper. We report on the latest and brightest ideas from the FinTech world. So first of all, I'd love to say hello to our online audience. Thank you very much for joining us. We've got a really interesting session here to talk about. So obviously in a very increasingly digital world, we now have vast amounts of mission critical data. The financial sector in particular has a responsibility to protect all forms of these digital exchanges and assets. And looking at the chain of custody is a particularly crucial and mandatory requirement for real digital peace of mind. Today's webinar is going to cover infrastructure and cryptography security. And we've got two great presentations for you, first of all. We're going to hear from Adrian, the CEO and founder of METACO, which is the foundation for a better, safer, faster digital assets. Very nice to hear you today. Thank you very much for joining us. What I'm going to do now is hand over the control of the screen and hear your presentation.
Thank you, Mark. It's a great pleasure to be here today and discuss this very interesting topic that is crypto custody and the adoption of digital assets in the institutional sector. I would like to start by sharing my screen to present a few slides. So give me a second. Very well. So maybe the first thing I wanted to discuss to kickstart this presentation is about the readiness of the market. So we've been discussing now in the last 10 years of the adoption of cryptocurrencies, the adoption of tokenization and digital asset use cases. And the truth is for many investors and many entrepreneurs, this has been kind of a disappointment. Today, obviously, may not be the best day to say that because cryptocurrencies are rising. They've just gained 5 to 10% in the last few days, and seems there is a lot of optimism in this market. But the truth is, tokenization was predicted to become a massive thing already, and it's still not yet happening. And the question we may ask ourselves is, why is it not happening? And is it maybe happening now? So I would say that there are four points which are essential to the democratization of cryptocurrencies and digital assets. First, you need to have demand. Of course, nothing happens if you don't have demand. Banks are not going to build if they don't have their clients asking for infrastructure for crypto services. And I would argue that demand on the institutional side was relatively weak in the last few years, but has dramatically increased in the last 18 months. So demand is coming, and I'll give you a few hints about why this is coming and also the extent to which it's coming. But there were mainly two other barriers that prevented this from becoming mainstream until today. One is technology. And technology generally is not the friction when we're speaking about the technological sector, because cryptocurrencies, after all, are designed by technologists, by developers, for developers. So I would argue technology is mature. But at the same time, the infrastructure for serious banks or institutions to get involved in this field is not and has not been until recently ready for massive adoption. What I will argue today is that this is something of the past. Technology and infrastructure is now ready. It has been proven now in the last almost couple of years with multiple banks globally that are operating and generating revenues with such services, that such a service is now possible from a technical point of view. Third point, and I mean this is the obvious, is the regulatory aspect. As you obviously know, no bank is moving proactively in an innovative field of touching securities or security regulations without full regulatory approval. This regulatory approval has been, in particular in Switzerland, and we are from Switzerland with METACO, has been early in the adoption of cryptocurrencies. The FINMA in Switzerland has been promoting the capability of Swiss banks to offer such services for multiple years. The framework has clarified, but it's only more recently that other countries started to clarify the frameworks and give a green light to the banking institutions. That's the case obviously in Germany. That's increasingly the case in Southeast Asia. And earlier this year, the OCC in the United States made a clear statement that it is now possible for banks to become active with digital assets. Maybe the last pillar is the central bank digital currencies, which we've spoken a lot about in the last 6 months with the COVID issue, and also with some competition coming on the market from private companies like Libra with Facebook. CBDC, still 2 years ago, were perceived as a very long-term thing, and they are now, if you look at the markets, 80% of the central banks are doing research about CBDC, out of which 40% of all central banks now have concrete pilots with proof of concepts with CBDC, and 10% of all central banks have decided they had short to medium-term plans to deploy a concrete CBDC offering. So I think these pillars, now that these 4 pillars are gathered, there is a very strong opportunity to for banks to actually leverage this new ecosystem and get active in this field. If you look at the last 10 years more in detail, so Bitcoin was invented and launched more than 10 years ago. I think it's now almost the 12th year's anniversary of Bitcoin. And it's gone through this bubble of incredible expectations, market going up, going down, a lot of volatility. And also it has been in a way used for use cases which are extremely frightening in the banking sector, such as criminal activities like buying drugs, buying weapons, hiring hitmen on the underground markets of Silk Road. But this was in 2013, 2014. It was a very long time ago, and obviously legal actions were taken, and most of these dark web sort of networks no longer exist today, or have become a very tiny part of the crypto community. Since then, the market has corrected in different ways. The peak of inflation has been passed, and somehow we've reached the thrill of this illusion. I mean, essentially, we've come back to a more realistic view of what cryptocurrencies and digital assets can bring to our economy. And although we certainly miss many of the incredible opportunities that are going to come in the next 10 years, we've reached kind of a plateau where we are confident. And when I say we, I don't mean METACO, I mean the financial industry, that cryptocurrencies are here to stay, that they are extremely powerful applications of smart contracts and tokenization. And therefore, we start seeing more and more large institutions getting involved in this industry, starting with early stage pioneers in this market, like Nomura making an announcement 2 years ago, Börse Stuttgart, infrastructure players like Swisscom or Avaloq, and moving now into much more mainstream, I would say, companies which used to be extremely critical and now are either investing massively in this field or supporting companies active in this field, such as JP Morgan or MicroStrategy, that invested a big part of its treasury, or more recently traditional banks like Standard Chartered actually building and offering services to manage cryptocurrencies. So I would say we've gone full circle. We're back into considering cryptocurrencies as now investable asset class. And in this context, obviously, METACO has been very active in building and promoting and deploying solutions that allow banks to get their infrastructure ready, and therefore provides and offer digital asset services to their clients. Now, a big part of the opportunity is also related to going beyond cryptocurrencies, about decentralized finance and tokenization. If you look at this diagram, you see that although Bitcoin has grown massively in the last 10 years, and even in the last couple of years, the market cap has grown very fast, it is still a tiny player in the whole universe of other assets and opportunities with decentralized ledgers. Think about DeFi, which now is this tiny dot on the left. Decentralized finance is promising to replace many of the I would say highly centralized and very intermediated services that we rely on today for derivative contracts, trade finance, payments, to replace all of that with sort of universal standards relying on the chain with open protocols that anybody can register to, and potentially to provide tools which may replace some of the activities of the banks as they are today. And so the opportunity that we're seeing here is a future world where not just cryptocurrencies are relevant, but in fact, every non-bankable asset has a presence on the chain. Every contractual relation is potentially expressed as a smart contract on the chain. And for all of these applications, which will represent hundreds of trillions of dollars, well, you have the appropriate infrastructure and services provided by the trusted partners on the market today that are banks and financial institutions. I would say, and this will be my last part on the generic market context, that we always face these three main objections regarding, why should a bank, why should I start doing anything with crypto or smart contract tokenization today? And these three objections typically start with the reputational risk. What if Bitcoin is used for criminal activity? Will our compliance department accept that? Will the regulator destroy us if we can't use these coins? How to apply proper AML controls? Well, I would like to debunk this point. I think this used to be the case that 5 years ago it was difficult to do this properly, and potentially no bank wanted to move into that field. Today, all of the tools exist to make sure that the risk related to the management of digital assets is as low as it is managing with cash or managing with many of the regulated securities on the market. The technology risk, second point, we've seen in the last 5 years many exchanges being subject to security failures, some of them which led to hacks or losses. I think that what we want to convince you today is that, and jointly with Unbound, is that this is not a concern anymore. It's not just crazy technology brought by geeks in a laboratory. This technology is now well mastered. It is running in production with many banks. Some of them are large tier 1 banks that operate such platforms with significant AUMs. So the technology risk, of course, anything that you initiate as a company is a new risk. And I'm not saying that there is no risk, but I'm saying the risks are well identified, they're under control, and to some degree, the upsides overtakes the potential risks that this opportunity brings to a bank. Now, the last one, really on the regulatory side, well, I mean, here there is not much to do except a bit of lobbying with regulators and waiting that regulators open up. But we've seen that there is not a lot of efforts to be invested. In fact, most of the countries which have been historically open to financial innovation have clarified or are about to clarify the frameworks for banks to get involved with cryptocurrencies and digital assets. That is the case, as I mentioned, of Germany, Switzerland, Singapore, the US, and particular states in the US. So I think that obviously, if you are in a country where cryptos are banned, you may want to not consider that use case for now, but it is no longer the case that if you are in one of these countries where regulators have given their views, it is not possible or it is difficult to operate. There are very clear frameworks, and it's well mastered both by technology companies like us and the advisors that have been involved in this field for now many years. Okay, so Mark, I will jump now into a few slides regarding Silo specifically. Silo is our main product at METACO. We call it an institutional digital assets operating system. It is the infrastructure that allows a bank to leverage a secure system to interact with cryptocurrencies, with tokenization use cases, and with smart contracts. This is typically the tool you would use to offer Bitcoin custody or equity tokenization or Ethereum trading to your clients as a bank. It starts with very simple use cases, custody, storing something, to more elaborate and interactive use cases, payments, payments, transfers more generally. But it also goes way deeper into things like tokenization and advanced smart contracts use cases, which I think are not the matter of the discussion today. So Silo is a platform which essentially does 4 things and does these 4 things very well. It has been designed for banks that wants to first custody or store assets, crypto assets. What does it mean to store assets? Well, if you are not familiar with digital assets, they have one particularity which they do not share with traditional securities. which is that they heavily rely on cryptography for their security. You secure your coins, you secure your Bitcoins, your Ether, your tokens by holding a secret which looks like a very long password, which is so random, which has so many combinations that it is assumed to be impossible to guess. And therefore, if you can keep it secure, your assets are secure because you need it to unlock your assets and to transfer them, for instance. So a big part of custody is about key management. How do you store these keys? How do you access them? And this is also obviously what I would like to discuss here with Rebecca later on at Unbound. This is where there are a lot of things happening currently on the market, which are not questioning what has been doing in the last 20 years, but which are bringing new capabilities that provide incredible flexibility and agility to such solutions. So I'll say a few words about this later on, but I think Rebecca will be obviously much more suited to present in detail why we are focusing so much jointly with Unbound on this component and how we think we can improve and improve the key management and the agility of custody. The second point, which actually is presented here as a first point, it's the control part, which I could rename governance or entitlement or permission system. What we've seen for most of the security issues that have occurred in the last 10 years with exchanges getting bankrupt or getting hacked is that quite often it's not about losing the keys. It is most of the time about an inappropriate governance system within the company, giving access to the wrong parties to the critical information, such as the secret keys. Think about this. If you have the keys which are very secure, but you give an access to the CEO or to the founder of the company to this special vault, and the guy potentially, when accessing the key, makes a mistake, or he's corrupted, or is blackmailed, or he may forget the password that him only is supposed to remember. So all of these things could lead to detrimental impact on the custody. They could lead to the complete loss of the assets. And what we see is that most of these issues are related not to the key management, but actually to what comes just outside of the key management. How do you secure who is allowed to do what in such a system? And so METACO has involved a lot of efforts, and I think it also goes jointly with what we're doing with Unbound, in making sure that there is an appropriate framework with the appropriate security measures in controlling who exactly can do what, with what controls, based on what risk factors, so that at no point in time can a single employee of the company or a single client trigger something which could go beyond the risk tolerance of the bank. The third point is, I mentioned it already, what I'm mentioning somehow applies to Bitcoin and Ethereum, but in the grand scheme of things, it applies to much more. It applies to tokens, it applies to smart contracts, and although in the short term we see many more applications to cryptocurrencies, I wouldn't be surprised that in the next 5 years, we're no longer relying on a lawyer to marry for a marriage, for instance. It may be that we have a contract straight on the chain that defines the terms of our marriage. Same for inheritance, same for trading. And what we see is that in the end, it becomes as critical to interact with tokens and smart contracts from a security standpoint than it is to interact with just simple Bitcoin. In fact, calling a contract and asking the contract to pay dividends in the case of an equity token, or pay coupons in the case of a fixed income security, can be as critical as allowing a transfer for Bitcoin or Ethereum. Another example would be, put yourself in the shoes of a stablecoin issuer, like a central bank creating a stable national currency on the chain. Well, if the mint operation or the burn operation, like creating more units or destroying some of the units, if these operations are compromised, well, the whole system collapses because you remove all of the trust in the currency itself. So it really shows how important it is to not manage something that's static, like storing Bitcoins, but also all of the interactions with the features of these coins, minting, burning, paying dividends, corporate actions, essentially managing the whole life cycle of the assets. Maybe the last point here is about connections. We see that the only way for such platforms and such technologies to be successful on the market is for established institutions like banks to have a way to connect this to their existing environments, the existing core banking platforms, and make it as smooth as possible to leverage these new technologies within their environments. Typically, what you want ultimately is that Bitcoin looks and feels exactly the same as Swiss franc, euro, dollar, and you can, as a client, connect to your e-banking platform and you see Bitcoin just next to the others. It should not be a thing that Bitcoin is backed by a special form of blockchain, that there are 10 confirmations, etc., etc. All of these things are technological details. In the end, they should be abstracted away to the end user, and the bank should see cryptocurrency as just a new asset class. So what is Silo? Silo, from a component view, is an infrastructure, if you look at the middle, that manages wallets. Wallets are, if I wanted to summarize, a wallet is just a bunch of keys, securing assets and maintaining the positions, balance, the transaction history. It's a system that manages all of the workflows around approvals, who can do what, that manages transfers in and out, manages tokenization use cases, and all of these things, if you look at the blue box, rely on the key management. And I'm going to focus on the keys just for the next slide, and then I will leave it to Rebecca to help me discuss the key management in the context of our collaboration. But the way it works is that you have, as a user within the bank, as an employee, you connect to the system. You have a series of wallets, potentially thousands of wallets. You can see the balance, the same way you would see a balance for traditional assets. And you can request to process a transaction. Anything that you do will be authorized with an external security device, an approval terminal. Will require multiple approvals, so it will be at least a four eyes principle. And on the backend will be connected to a series of services, such as, for instance, a core banking platform like Avaloq, a liquidity provider, or a liquidity service such as provided by AlgoTrader, compliance services to check that you're interacting with appropriate addresses or transactions, and all of these being connected in real time with the underlying ledgers, like the Bitcoin ledger, the Ethereum ledger, so that you can have instant settlement with what's happening on the chain. Now, the point that we're discussing today jointly with Unbound is really this point about keys. And this will be my last slide. I mentioned that keys are this essential component to secure, in order to secure digital assets. If lost, destroyed, or stolen, so is the asset, and there is no recourse. Potentially, you've lost the asset forever, which is why it is so critical that a bank implements the appropriate controls around the key management and has also the appropriate technology to manage the keys themselves. Historically, in the last 20 plus years, hardware security has been the I would say general approach and consider the best practice to store keys. Essentially, it is about having a special purpose hardware which is designed precisely to maintain a high degree of confidentiality around the keys, to generate secure keys and to ensure that they never leak outside of the hardware. This is also how METACO has started working on such a service, on such a silo platform. We heavily worked and we still work with hardware. But in the last few years, a cryptographic innovation, I would say, which is known now for pretty long time, but has had applications only in the case of cryptocurrencies in the last few years, has appeared on the market, and it's called multi-party computation. The idea of multi-party computation is to, rather than store keys in a trusted hardware, it is to remove this trusted component and say, well, I don't have to trust hardware. I could as well just take this key and split it in multiple fragments and put it in a way that if you want to break the key, you have to break all of these fragments pretty much at the same time. And so it's a completely different security model, which doesn't assume trust in the hardware, rather assumes trust in the fact that distributing an element into multiple fragments makes it harder to break because you have to break multiple layers or multiple components at the same time. And so maybe I will conclude before I give this description to a much more competent person on MPC, that what we have seen as a significant advantage with MPC over hardware is its ability to, first of all, not have any dependency to hardware in contexts where potentially the maintenance can be painful. maintaining hardware, in particular on-premise, is something that is costly and that requires very special expertise to avoid exposing the keys themselves. Working with multi-party computation makes it relatively straightforward to create keys and maintain keys in the cloud in an environment which leverages the most modern virtual machine management systems, Docker containers, Docker container orchestrations, in a way that so-called hot wallets, which require agility to process transactions in and transaction out, with as little interaction as possible, do not require complex infrastructure. They can be secure, yet rely on the most modern cloud technologies. So in this context, we have partnered up with Unbound. Unbound is a well-known company in the field of MPC with extreme competence in that field. And we feel that a company like METACO should not be telling its clients what technology they should rely on for key management. We think it is not our role to tell a client that they should use specific HSM versus MPC. We think that both technologies have extremely strong arguments for themselves, and a technology provider like us needs to be able to provide both and then advise our clients in which to use in what specific use case. And this is my conclusion.
Thank you very much, Adrian, for going through that. I think what we'll do now actually is to hand over to Rebecca to continue the sort of conversation about the partnership. But what I'd like to do is bring you back on after Rebecca's spoken so that we can then answer some of the questions that have been coming in and do a small sort of panel session. So thank you very much for your time there, and we'll hope to look forward to seeing you later.
Thank you, Adrian, for a great presentation. I really like the fact that you summarized the presentation with saying we're pretty much technology providers. We're agnostic as to the type of technology that customers choose, but it is our duty to be have enough integrity as professionals to be able to recommend the right technology or the right security layering for a specific customer or for their specific needs. So my name is Rebecca Aspler. I'm Director of Product Management at Unbound Tech, responsible for the blockchain use cases, whether financial services or enterprise blockchain. And it is my absolute pleasure to join you today and try and add value as to what Adrian said with regards to MPC specifically and how it bundles up with different technologies, specifically of MetaCos. So to start with, it is my privilege to be working, and there are a bunch of slides, but I'm actually gonna either skip some of them or just briefly mention some of them, because some of them might, I would say, correspond with just Adrian said, which is very lovely in the sense that the industry is pretty much consolidating and maturing, and companies are beginning to say, very similar things. That's a really good sign of a maturing, I would say, atmosphere, which could not have happened 4 years ago had we spoken then. So it is my privilege to be working for these two gentlemen, Professor Yuda Lindell and Professor Nigel Smart. Both of them are actually academia persons working on mathematics. This is their expertise. This is where they take their pride. On MPC within the industry, I would say the applicative manner of using MPC is pretty much even, I would say, like a side hobby for them, and they've been able to open up a business company, because they've been able to reach a mathematical breakthrough that took MPC from 9 minutes, I would say, time of computing into milliseconds. And when something takes milliseconds time to compute, you can think of many business applications. So behind the scenes, this is pretty much what MPC does. You have different flavors of MPC, as you can see. You could have server to server, which is the flavor that we're going to utilize with METACO. We have server to one endpoint, and you can imagine how one would authenticate to any system, sign transactions, payment transactions, etc. And there are, of course, the more, I would say, complicated use cases where you use server to multiple endpoints. This is the example that is shown here. So you can imagine behind the scenes how many key shares are being created in the same time, the same milliseconds, I would say. Very importantly, the key is split into n random shares. It's mathematics. We don't care about the number of shares. This could be 20, this could be 50. We're agnostic as to the number of shares. They could be placed on any hardware. The keys are never brought back together. And shares are being refreshed continuously. So there is no chance that one would break into one, I would say, hardware and then to the second and the third, etc., because the key shares are being refreshed constantly. So these are, I would say, the three flavors of MPC. Very briefly, touching base on the market state, I've been doing blockchain for, I think, 4 years now, and it's a major change since 4 years. Since we started, I would say, preaching blockchain use cases, then these were very much experimental type of use cases, and now they've evolved. You see the regulators are catching up, as Adrian said, and interestingly, the institutions are also catching up. So this is, I would say, a map of the blockchain use cases that we're seeing, and also the platforms. So you can see them divided between mostly financial services and enterprise blockchain. All of the names that are mentioned below, I would say, each type of use case are actually use cases that are in production. And you can see the names over there. So these are not small names, even though there are many small players out there. We're going to focus today specifically on the financial services and even more on the custody type of use cases. And I would urge you, I would say, to think about these types of sub-use cases: full custody, co-managed, and non-custodial, which is pretty much the wallet use case that everyone knows, because we're going to dive into these later on. And this is a slide, I would say, a variation of a slide that Adrian showed earlier. But you can see the names that are coming into the industry. Investors, the institutional investors, are asking banks to invest a certain % of the portfolio in digital assets, and therefore they need to be offering those as part of the portfolio services. Now, I like this slide very much because it shows the fact that blockchain digital assets are simply one more type of asset. These are not considered anymore to be more dangerous, I would say, than equity type of assets. For example, everyone knows that startup is a very dangerous type of business to be dealing with, just as an example, or specifically commodities. So blockchain digital assets are simply just one more digital or one more asset class that banks are getting their hands, I would say, into. Now, and this is where we start going into the risks and how you can mitigate them. Up until now, we've talked about those multiple threats. You can see I'm not going to dive into each and every one of them. We don't have the time today. But most importantly, because the asset is the key and you don't have to steal the key, you can simply see the key to be able to empty a wallet out of its assets. You can see here the garden, I would say, of breaches that have happened during, I would say, the last few years. This is an outdated slide. There have been more hacks since then, but I think that the garden is very much flourishing, as you can see, because at the end of the day, companies smaller or bigger are not guarding the keys very well. So this is, I would say, our job, ours in METACO, to be considered as trusted advisors as to how one should keep the key. You can see here additional threats, outside attackers, inside threats, those CEOs, as an example, that disappear, presumably dead, but actually living elsewhere, operational errors, of course, regulatory requirements, etc., etc. Now, interestingly, when you think of institutions and the threats that they're dealing with or the requirements, these are, of course, a bit different than the ones that I would say a typical wallet would have to handle. And you can see here the three groups. We don't have the time to dive into each and every, I would say, parameter here, but I'll briefly touch on, I would say, two groups of them. So I would say that one added value for me to be hoping you would take here from here today is actually, if you're a technology provider or if you're a vendor that is dealing or servicing an enterprise of some sort, please bear in mind that these, I would say, former threats that I've shown are, of course, still valid threats. But when you're dealing with enterprises and institutions, these are the ones that they'll be looking to address. And diving into the first category, it is important to understand and to even educate your customers or your vendors or your end consumers that there are various technologies of guarding keys. You know, we're a key management startup or a company. This is our expertise. We're cryptography ambassadors. So this is where we focus. not so much on the business side, on the operational side, but very much on security layering. So everyone knows, I think, I hope, of the 4 types of technologies out there, whether it's HSM, whether it's trusted execution environments. Mostly the known one is SGX. Multi-sig, I think that everyone knows of, usually limited to 2 out of 3. And of course, MPC, which I'm an ambassador of today, representing Unbound. Interestingly, and again, we don't have the time, but you would I would very much appreciate it if we took it offline. If you have further questions, each and every one of those has their own, I would say, advantages and disadvantages. And it is very, very important, therefore, for you to be able to trace the parameters that are relevant for your needs, for your customer needs. Now, additional way to look at the same technologies is actually from the solution point of view. So these are not just the technologies themselves, but actually how you bundle them or how you layer them. And METACO has very smartly been doing, I would say, a portfolio of layering, security-wise layering. It could be done using the, I would say, institutional management and operational management system that METACO is an expert in, using an HSM as an example. But it could also be done using an MPC, and therefore METACO and Unbound would fall under the category of a security provider. But there are additional, I would say, examples, for example, using a SaaS type of solution, which to the best of my understanding, and maybe Adrian will then validate yes or no, METACO solution could also be offered as a cloud-based service, not just as an on-prem based service. So therefore, yes, is it true, Adrian? Correct. Cool. So you can see here also the flexibility of how we could work together. It could be on-prem, it could be on cloud, it could be do-it-yourself type of solution that one would build with its advantages and disadvantages. But it could also be a bundle and a layering of the types of solution using external service providers. We'll look at it in a bit more later on. This is a table this is just an example table for a custody type of use case, but you can imagine this type of grid for different types of use cases. Let's say identity management, trade finance, supply chain management. You can think of all, I would say, the use cases that you might be interested in. But what I would encourage you to do is actually take those 4 types of technologies and see which parameters would be relevant for the solution that you're trying to build or define, and actually choose the technologies that are best or more suitable for the needs that you need to comply with. So when it's a custody type of use case, just as an example, FIPS level 2 up to 4 is a critical type of parameter to comply with. You will not be able to offer or provide your customers a custody solution if you're not complying with at least level 2 type of certification. But if you're doing, just as an example, supply chain management or identity management, or maybe credit points type of clubs, etc., FIPS level 2 is a nice to have, but certainly not a mandatory. So when looking at such, I would say, a grid, you can start, I would say, acknowledging why Adrian has very, I would say, sorry, let me just put it, I'm arranging my screen. Adrian and METACO have very smartly decided to be, I would say, as agnostic as it possible to the technology that they're offering their customers. And therefore they are able to offer the institutional grade system that METACO is offering using HSM as an example, which has FIPS level 2. And it's also hardware based for the customers that are relying on hardware or need to rely on hardware. But it could also be offered using MPC, as you can see, with its advantages. And actually, at best, you can actually combine and layer different types of technologies to be offering actually the best of breed type of solution. Now, just out of, I would say, relevant or general type of statement, Unbound is a proud member of IBM. So when one would need hardware on an HSM, this is just an example of a layering of an MPC type of solution together with an HSM level 4. But if we would focus on the left-hand side of the slide, you will see that Unbound actually is able to break the key, as you remember, to several parties. In this case, an example of two-party server to server. Now, the advantages for people that might not be aware of the advantages of VHSM versus a traditional HSM, you can actually see here two types of categories that we've analyzed. There are the security aspects of a VHSM type of advantage. As you can see here, the traditional HSM versus the VHSM. And there are, of course, the management and operational point of view that is very much, I would say, in favor of the VHSM versus the traditional HSM. I would like actually to go back and just emphasize one point that is critical in blockchain, because people very much rely on HSMs as the best, I would say, security solution. But with blockchain, it isn't stealing the key, it's actually just seeing the key. So the protection of someone preventing from key misuse is a critical, I would say, key success factor when you're building a blockchain security platform. And therefore, relying on HSM, if you're deciding to rely on a physical HSM, would require you to rely on must rely on additional management layers, such as METACO would bring to the table. But I really urge you to take care of this item if you're not about to use METACO or Unbound and are relying only on HSM. Please add an additional security layer to be able to protect key misusage. Moving on to the two other groups and keeping it brief. So if we're focusing on the custody use cases, and you can see here the three subtypes. So business-wise, the full custody means that the bank would actually keep all the key shares if we're speaking MPC, or full keys if we're speaking multi-sig as an example, or one key if it's an HSM. The key would be on the HSM of the bank. Co-managed, you can think of the number of key shares being spread between multiple parties. And non-custodial is where the customer, the end customer, would be the one to be liable and therefore holding the key. So working together with METACO, we're about to have actually a new solution into the market where there's an Unbound VHSM behind the scenes, having two key shares, one on one server and the other on another server. And METACO's solution would be the, I would say, entire management platform above, I would say, that key that is being protected using MPC. Now, this is another way to look at it, this time from the deployment point of view, because VHSM is by its name a virtual HSM. So we're agnostic as to the cloud that we can work with, and METACO, I'm surely, is the same. So I can surely say so. So you can think of the distributed and segregated environment that you can build. So if you just focus on P1 here and entry point P1 here, so if we even just talk about these two, you can have a server on-prem, let's say on METACO side, and you can use AWS to host another server and have the second key share on the AWS side. And let's say the customer would be the one to host the AWS servers. So liability is actually shared and co-managed between two parties. It doesn't have to be like that, but it could be. You can think of the additional layering, deep layering of security when you have the key shares being spread between two clouds. And you can imagine METACO solution actually as another layer above all of this security-wise, offering the entire management, I would say, advantages that are suitable for enterprise-grade type of organizations. Now, this is another example of how you can leverage MPC, this time using multiple endpoints and therefore creating very sophisticated type of policies. In this example, you have a total of 5 out of 9 in 3 groups. Now, may I remind you of the fact that key shares are always being refreshed. So therefore, even if a hacker did manage to get their hands on the customer key share, for them to be able to break into each of those, I would say, other 9 types of key share holders, they would have to do that simultaneously, which is, of course, impossible. So this is just another example of how you can leverage the security by distribution type of paradigm. And this is exactly it. Thank you so much for your time. I hope we have some questions to maybe think of together.
Lovely. Thank you very much, Rebecca. I'm going to ask Adrian to join us back on screen now as well. Got a couple of questions here to look at. And I think, obviously, from my perspective, 2 great presentations. And it's quite obvious how you can see how sort of you're both working together and how the 2 product offerings complement each other quite nicely. Just to sort of a couple of questions that are coming in, and it's coming down to questions to hear about your take on regulation and how the sort of the specifics of each of your technology address certain bits of regulation that may or may not be coming into force. I don't know who wants to have a stab at that first. Maybe Adrian, as you haven't spoken for a couple of minutes.
Yes, pleasure. So, I mean, obviously, I'm not an expert in law, but I will give you I will share what I observe on the market. So, first of all, it is very jurisdiction specific. What applies in Switzerland may be different from what applies in Germany or in the US, obviously, like every regulation. But one example is what qualifies a custodian as a custodian. For instance, it's not because you hold keys and you manage these keys that from the legal point of view, you have you need a banking license as an institution holding assets for the sake of your clients. In Switzerland, if you segregate your assets appropriately, typically by having different wallets for each of your clients, well, you're able to operate as a custodian pretty much without regulatory control. So I'm saying pretty much because, of course, there are things like financial intermediation, AML, etc., which may kick in, but you're not subject to a banking license, for instance. And this framework is even opening up where, in some cases, having the assets of your clients as a custodian being merged or within an omnibus account may still even qualify as a say regulation-free custodian. And of course, don't quote me on that. I hope the regulators don't listen, but it's a much lighter framework in a way. If you go on different jurisdictions, it can be very different, where potentially as soon as you hold the keys and your client doesn't have access to the key, or you may have a technological capability to trigger a transaction without your client approval. In these countries, potentially, it is heavily regulated. And I think this is where an offering with MPC is so strong, because you have this native capability to split the key between the quote-unquote custodian and the clients or in the bank, and therefore to share responsibility and guarantee that neither of the parties is able to execute a transaction alone. There is a joint approval for any operation. So I can't give a general statement about the status globally about every country, but my point is, yes, there are specific points in every country, but I think MPC brings here a very powerful solution to make sure that even in the most painful, I would say, regulatory contexts, you have a solution where the custodian can push some of the responsibility to its clients.
Okay. Rebecca, did you want to add anything to that?
Actually, I'm looking at these questions. May I take something out of that?
Yeah, absolutely. Please do.
We're not having so much time, and I am echoing everything that Adrian said, so I'm trying to add value. So there are 2 questions here about the regulation. Sorry about that. And I would like to echo what Adrian said. We serve, and also METACO serve, only, I would say, the business type of customers. And we're very much, I think, I'm speaking for myself, but I'm sure that METACO feels the same. We're very much respectful of the pace that enterprises and institutions are taking when servicing their customer. It's a matter of trust, and trust is still not there when you think of the mass public, the families, people that make an honest day of work and need to provide bread for their families and think of their pensions. So for us to be able to serve banks in a very responsible type of way, assuming that regulations are there to serve these audiences, we're very much, I would say, honored to be able to be trusted by both investors, by both, I would say, institutions, to be able to supply solutions that are going through any type of pen testing, academia reviews. We're very responsible people. So I would never work for a company that is in any way taking advantage of people to make more money, never, ever. And it is causing me, I would say, issues with, I could have earned so much more had I chosen to work for these, presumably dead, but actually living somewhere else. But we're good people, and we trust the regulators to do their own, and we're them.
Yeah, I mean, it's an interesting point. Obviously, as both of you are first and foremost technology providers,
yeah.
You're not regulators, and therefore it's a little unfair to ask you guys to comment on, what a particular government's regulatory body sees as important for their particular citizens. Yeah, so I think we kind of understand that. I guess the sort of idea in my head is obviously the general requirement with or the concept of digital assets obviously has had a bit of bad press probably from its inception, and it's always what everyone always talks about is the security and everything else. So I guess a lot of people are sort of quick to sort of throw that one in and sort of start thinking about it, as you say, about normal, not use the word normal people, regular people in their day-to-day lives, and what impact the security or the sort of the holding of keys has on those people's lives is kind of I guess a little bit of what people are sort of asking. We've got an interesting question here from Joey Rothbard, I hope I'm pronouncing that right, saying, can you describe the best practice for storing the MPC key shares? He's also mentioned within a regulatory financial institution in context. So I don't know if that is something that one of you would like to take on.
Maybe I'll start, and Adrian, maybe you'd like me to. I think that METACO and Unbound work perfectly together here. So MPC is mathematics. For that, we don't care where the key share is stored. A key share in that sense is a simple data file consisting of a random number that is being produced. At the end of the day, if one really could want to, but it's not feasible because the number is really long, but you could also store this number on a specific, I would say, file, key, notepad for that matter. So mathematics wise, it doesn't really matter where the key is stored. I would say that working with institutions, as Adrian mentioned, institutions, specifically those that are regulated, are perceiving MPC or are required by the regulator to be storing MPC very much, I would say, air gap type of even offline servers. So it's a matter of, I would say, the comfort zone of the regulator, the bank, the end customer, where you have to put on your website, it's air gap, etc., etc. But at the end of the day, MPC is just a random number split between n shares. So it doesn't matter where you put it.
Yeah, I don't know, Adrian, if you wanted to comment on that as well.
Well, I mean, I don't want to comment specifically on the backup of the MPC key shares, but I would say, generally speaking, what we see being implemented is quite often the bank, even in the context of secrets being split with MPC technology, will want to have a highly secure and durable storage medium for these fragments in case of a requirement for recovery. In principle, we assume that recovery is never required, but it is often regulatory requirements and also kind of a peace of mind to know that in case you lose your access to your cloud providers, or in case your quorum gets down for some reason, you have this offline recovery mechanism potentially from smart cards or potentially for encrypted data files that allows you to reconstruct the entire key hierarchy.
Yeah, and one thing that I was sort of thinking is the sort of obviously the requirement of sort of cold storage and warm storage and everything else that was sort of been talked about a lot. Has that been one of the limiting factors, do you think, for larger enterprises and institutional investors getting more involved in digital assets, because they that fundamental hardware requirement is holding them back a little bit?
I mean, there is no doubt that managing a cold storage is extremely painful and costly and error prone. If you look at what exchanges do today, is that most crypto exchanges put 95% of their reserves or something like around that number in cold storage, and they hope that they will never have to touch it and that they have enough liquidity in a more connected hot wallet. And generally, the hot wallet has been the component that was compromised because it is closer to the network, closer to the internet, and therefore more exposed to some degree. However, most hot wallets have been also neglected in the way they were implemented. Typically, they were implemented with a key in the database and with basic controls around it. And what we're speaking about here with Unbound is precisely having these hot wallets being much more secure with appropriate controls around the hot wallets and appropriate key distribution even when it's connected. And what we see is that although we may diverge here with Unbound, we still think that cold storage has strong applications, but really for use cases like long-term custody, where you're not going to access the assets and you want to remove any form of a connection to a network. We also see that the value of digital assets is not in just storing them; it is in using them. And this is particularly true with decentralized finance, where you want to get some yield with your assets. You potentially want to stake your coins. You potentially want to invest in products. And this yield generation opportunity requires that your keys are available, which you can't have with the cold storage.
Yeah. And I think that's, as you say, as in the original sort of starting areas, when it was a person held a key, a person held a digital asset, then these sort of issues weren't as much of a problem. But now actually there's more mainstream adoption, it's becoming more and more sort of relevant to have more involved and secure technology systems to be able to manage this in a way that can then be shared within an institution's range of customers, etc. Just thinking a little bit, obviously, trying not to take up too much of everyone's time, but maybe just sort of a little sort of look into the future. What sort of do you see as the role of digital assets playing into the future, and how will that affect sort of retail investments and other international institutions as well? Maybe ask that to Rebecca. What do you see for the sort of 2021? I know future predicting is quite difficult at the moment, given current world pandemics, but what do you see things moving into next year?
So actually relying on what we see with customers, we've just signed with a few new customers in the last, I would say, 3 months. And these are customers that have been, I would say, waiting for 2 years now, up until the last 3 months. And it seems as if, I don't know to what it is related. I don't think it's COVID or anything, but it seems as if people have come to understand that digital assets are here to stay. And therefore, you're seeing big banks, big payment companies, again, no specific names, but there aren't many of those, the largest banks in the world, the largest payment companies in the world. And all of them are now getting into crypto seriously, taking it out of the lab, moving on to production, considering various types of solutions, considering different types of architecture. So to answer your question very briefly after this, I would say background is investors, and it doesn't really matter if these are institutions investing or private consumers, are requiring banks to have some of their investment portfolio invested in this new asset class type, which is digital assets. And banks no longer can wait outside, I would say, of the picture. And the fact that the regulator is very much, I would say, approving of those now, relying on the Wyoming law and FinCEN guidelines, which have been updating themselves in the last 3 months or 6 months, I would say. It's just going to be a new asset class that needs to be protected, as simple as that.
Absolutely. And maybe just turning to Adrian, maybe your sort of the final thoughts and what you see for the future, building on what Rebecca has just said, really.
Yeah, so I think the next big 3 milestones are going to be a disruption of payments, how payment is operated. We have now more and more stable coins coming on the market. Libra is one of them, but obviously the next big thing will be central banks getting in payments by offering central bank digital currencies. I think that's the first step. Second step is tokenization, assets tokenization, where equities, fixed income securities, derivatives, arts, non-bankable assets become standardized around a single, or at least a small number of standards around open ledgers like Ethereum. And maybe the third point, and this is a bit longer view, but is that at some point we will move a lot of the contracts themselves onto the chain, thinking about distributed autonomous organizations, which will probably to some degree replace companies the way we know them today. So I think that we are still not seeing the entire set of possible applications of distributed ledgers, but one thing is clear, it's not going to limit itself to financial applications.
Yeah, I think that's absolutely true. We've kind of come to the end of our hour. I'm afraid to say we could probably go on for a lot longer. Just wanted to mention to our audience, if we didn't get around to answering your questions, then please don't hesitate to email it over to us at which is webinar@thefintechtimes.com. If there's any specific questions for either Rebecca or Adrian, or even of the two companies, feel free to send them on, and we will also then forward them on to the relevant panelists. So, but Rebecca, Adrian, thank you very much for your time today. It's been an absolute pleasure hearing from you and talking with you, and look forward to continuing the conversation from here.
Thank you.
Thank you very much.
Thank you very much.